Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This is a bonus episode featuring Jem Karsan. Jem is a different type of investor than is typically featured here. He is a volatility guy. He's focused on things like dealer positioning, and he has a passion for macro, and I enjoyed talking to him immensely. I will tell you, this is not an uplifting conversation at the end of it, but Jem is very thoughtful. He's super smart, and you can't find somebody that says something bad about him that knows about his career. So that's a pretty good thing. I don't know what else to say. I hope that you enjoy this, and I hope it sparks some thoughts. Probably the biggest takeaway that I had was the idea that equities are really just a derivative of the options market, which is the probabilistic expression of what the equity valuation implies. I've always thought of options as the derivatives. I've never thought of the equity market as the derivative of the derivatives market. If you find that thought interesting, you're going to love this episode. And that's all I got to say on that. This episode is sponsored by Bastier Partners, a boutique investment bank. Bastier's founder and managing member is Nader Afshar, a fan of the pod. Nader is described as a connector, high integrity, a low-key version of Byron Trott, and the rare investment banker that focuses on the alignment of interests and incentives. I appreciate him and his firm sponsoring the podcast. As always, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making any investment decisions and do your own due diligence. With that out of the way, I hope you enjoy the episode. I certainly enjoyed recording. Hope Jem comes on again sometime. Excited to be joined by Jem Karsan today, an investor that is, I would say, a different style from the typical fundamental investor that may be featured on this show. But I'm super excited to introduce your style and you to my listeners, and I appreciate you saying yes. Also, you're in Chicago, so you're inherently a good person.
Thanks for having me, Bill. Good to be here.
So do you want to give a little background on who you are and what you do and how you view the world so that people can kind of frame the conversation?
Yeah, I'll start from the beginning. I came out to Chicago in 1998 on the tail end of long-term capital management. It was an interesting time right at the end of the tech bubble. So that's definitely shaped the way I see some of the things in the world. But I came into the market making world, particularly in the options and vol space, and eventually built one of the biggest market making operations in the equity index vol space. And we were at our peak, 13% of the volume in the S&P 500 options. And one of the biggest,
wow.
One of the biggest players, toe to toe with Citadel and Susquehanna and all the other big boys with quite a bit less capital, but really great quantitative models. And really, I think what made us unique from the very beginning is the edge that we have in our quantitative models, our approach to reading dealer positioning in the option space and the effects that it's had. And that's something we still very much talk about and use in our current business, as well as really just this deep understanding of relative value, the structures and how everything connects, how the inner plumbing of the market connects. So that's kind of how I grew up in the business. It's still a big part of what I do. Sold that business in 2010, really took my small family office, and I eventually started running some strategies that were created on the back end from the market making operation. And eventually that became an asset management business because we have people co-investing. And now we run 3 non-correlated strategies that focus on the vol space, the dealer positioning in it, and positioning accordingly, as well as, again, relative value, vol arbitrage. We have a long vol version and a vol neutral version of that. So, I've been living in this non-correlated world, creating kind of real alpha for a while. Nobody seemed to care for the longest time because, stonks go up. And now that stonks don't go up, people seem to care again. And so it's an interesting time to be in space.
I have typically only featured or focused on value investing, stock picking, but I would say it was sometime last year I started to talk to Jason Buck a lot, and he got me interested in different asset classes, and I have twiddled my thumbs thinking about allocating to vol and vol strategies. And I continue to think about it. It would have been a very smart decision about 9 months ago or so to actually follow that thought. But I'm not sure that we're done with this whole allocation opportunity. So we'll see how all that goes.
Yeah, I mean,
but I appreciate it a lot more.
Here's the thing. Yeah, people are kind of starting to tune in, right? And we'll get into macro probably a little later in the conversation, but it's important to note that what's happening here is not your run-of-the-mill kind of pullback in markets. There's big structural issues at hand here that really speak to kind of big flows, not just talking about the Federal Reserve, but from a physical perspective, from a macro global flows perspective, that really changed a lot of the dynamics that we've seen for 4 years. So we'll dive into that at some point, but I do think it's important to note that. And it may seem like, oh no, I'm too late, but there is a lot afoot here, and this is really kind of an initial kind of bout of volatility that could be a lot more here.
Well, I think something that's interesting is we were sort of in a period where, for lack of a better term, pixie dust and hope got really rewarded and people were willing to look out forever. And, I mean, I tried to get my brain to look out too. Thankfully, I avoided some of that. But now it seems to be the market is saying, okay, well, what can you prove that your business is today? And there's still a lot of air on a lot of these valuations. So I don't know at what point this ends necessarily for certain companies. And then conversely, there's these value stocks that have just not been able to catch a bid for a long, long time. So it took kind of Ukraine to get some of that moving. And it had me kind of questioning a little bit more of the fundamentals versus flows questions and how markets work. So I'd be interested to hear you talk about kind of your theory of the case on that.
So I've talked about this, but I think it's important to kind of step back and look at the big picture. One, fundamentals do not matter directly to capital markets. I know that's gonna sound crazy. The reason that how they matter is to the extent that they create demand. Okay, so at the end of the day, people lose sight of the fact that markets are simply much like the Rowan Fora. You go and there are buyers and sellers, and it's a function of supply and demand. And wherever the price clears is where things are. And people lose sight of that. Fundamentals do matter to the extent that they create demand or supply, right? And in a market where money is free, interest rates are zero and liquidity is widely available to individuals as well as in institutions, cash flow and the fundamentals that drive discounted cash flows, that concept does not create demand or any demand that's really ultimately meaningful. The value of money being at zero means discounted cash flows matter zero. I mean, we know that in terms of a spreadsheet, but in terms of actual demand, supply and demand, it actually creates almost zero demand relative to how much demand there is. So think of it, I've used this analogy before, it's kind of hokey. Some people have listened to me before, probably heard me say it, but I'm gonna repeat it here. Imagine you're on an airplane, right? And you're 1,000 feet off the ground and those jet engines are firing. That 1,000 feet off the ground is the value, your valuation. That's your cushion, it's cheap, right? You're not far off the ground. But what's actually projecting you in a certain direction is the liquidity, is the demand, right? And the more you get off the ground, you go to 10,000, 20,000, 30,000 feet, things get expensive. But as long as there's demand driven by liquidity, you're going to keep going in a certain direction. And if you're on that plane, you probably don't. Yeah, you're now 30,000 feet off the ground. That seems scary, but it really doesn't matter to where you're going. What matters is the demand itself. Now, the second that those jet engines start to sputter, right? There's less liquidity for some reason or another. The Federal Reserve decides to pull money off the table. You have a liquidity crisis for some reason or another, right? How high you are off the ground is the only thing that matters. And if you are on the ground and you have unlimited cash flows and you can or you have enough fuel on board that you can keep kind of shoveling into, your engines, you're going to keep going in a good direction. Actually, it'll be better for you in the long run because you'll be able to buy kind of growth names and you'll be able to buy back your stock when nobody else can, and yada, yada, yada. So the value of cash matters. Fundamentals and cash flows matter to the extent they help you provide liquidity. They're a put on your business, but they do not determine the long-term trajectory per se. Demand broadly does. And so liquidity is ultimately the only thing that matters. Demand is the only thing that matters. But to the extent fundamentals create liquidity and drive liquidity in a time of illiquidity, they do obviously matter. And that's what happens. Eventually, you get a liquidity crisis. And when you get a liquidity crisis, value and discounted cash flow names not just outperform, they dramatically outperform. And they actually not only survive, they end up being able to, when all the creative destruction happens from all the growth names that don't have cash flows, et cetera, they get to kind of pick up all those pieces and benefit. So I think that's the broad kind of mental framework to use when you're thinking about fundamentals versus flows. Flows are ultimately the final say, but when flows dry up, fundamentals are the only flows, and that's what matters.
Huh. That's interesting. I have a buddy, RJ, that sent me a note, and it's from a well-known forecaster. And I'm pretty sure he said that in tightening cycles, there has never been a tightening cycle that didn't result in some form of a financial, I don't want to say a crisis, but I do think that's the word he used. But he defined 1987, the crash, as a crisis. So I'm not sure whatever the word needs to be, but what I'm hearing you say, and that like quote is ringing out to me. It seems as though you come from a period where we were certainly awash in liquidity before, and people aren't ready. And all of a sudden people are looking down and they're saying, wait, I'm 40,000 feet off the ground here. That is not fun. And then I would think that it creates even more of a liquidity tightening because people want to hold on to the cash that they have potentially.
Yeah, valuations on not just a weekly or monthly or quarterly, but even annual basis, valuations are, there's plenty of research about this, do not have predictive value. They do, however, on a long-term have predictive value. And the reason that they do over multi-year, decade-long periods have predictive value is because ultimately you do generally in a decade-long period at some point get a period of illiquidity and things come back into line. So they're really a risk management tool. They are not good for investing in the short term, but they are a risk management tool.
Interesting. Okay, so just playing back where we were, macro was said to be dead. Shorting was said to be dead. No one cared about vol, right? Didn't we had that year where like stocks never went down more than 1% in the entire year or whatever?
Yeah. The lowest realized volatility by 30% of any other year in history, 150 years.
Yeah, that's crazy. So like, what creates a year like that in retrospect?
We know exactly
and sort of did you
we know exactly what it was.
Okay.
We have proof. I can talk about that. Yeah, we can dive in. That's my
I'd be super interested.
That's the vol space. There's so much liquidity in the market that there was a search for yield, the TINA effect, people call it, right? There is no alternative. And what that led to is a reach for yield where people started selling implied vol, essentially collecting risk premia in order to capitalize. Companies like Allianz, which is in the news now for other reasons. Catalyst funds was a big one. A lot of big entities started selling really tremendous amount of index vol. Diversified. Selling vol it's an insurance product. At the end of the day, they became insurers. And the problem with selling insurance is it's intrinsically connected to the markets themselves. There's a reflexive effect. It's not like you sell tornado insurance and then so there's less tornadoes, that they're unconnected things. But when you sell insurance in the market and you do it in mass, somebody has to buy that insurance. And that ultimately are banks, dealers, and market makers. Somebody has to hold the other side of the trade. And if it's all selling for, and overwhelmingly so, the dealers and the market makers, whoever buys that stock, those options, has to buy when the market goes down and sell when the market goes up in order to capture a profit. When it's that low too, it doesn't take much. So there was so much vol supplied in the market at the index level, not the single stock level, that it essentially pinned the index for over a year. A lot of the supply was not just started with these big funds, these insurers selling it in these funds, but it also was short vol ETFs, right? So a lot of retail was an easy game. You just went and sold vol, and every day you came home and you collected money. That creates a moral hazard broadly for funds that are selling it, because they're probably not going to be around in 2-3 years after it blows up.
There was the one that blew up, right?
So, but XIV in particular, in February of 2018, was the one that imploded out, created the volpocalypse of 2018. So we know how much open interest there was. We know how we had an order of magnitude more vol selling than we have now, and it reflexively pinned the market. We know that because the index level had the lowest realized volatility by 30%, as I mentioned, of any other time in history in 125 years. So it's out of sample with hundreds of years of history by a lot. And at the same time, we had the lowest correlations of underlying stocks in the indexes by 25% on 125 years of history. Why is that? How are those two things connected? Well, vol selling is happening at the index level. The index gets pinned, but idiosyncratic risk still exists. Stocks still go up when they were within one standard deviation of historic norms. Single stock vol was not weird. It was the index that was not moving. And so if the index is pinned, everybody thinks the index is a calculation that summarizes the individual stock's total net worth. But the opposite is actually true. The index has become such a center of trading, more so than the single stocks, actually, that what the index does actually affects the single name stocks themselves. So if you have idiosyncratic risk, a stock comes up with a cure for a disease or a new technology, it still went up, right? The problem is the index was pinned, which meant other stocks had to go the other way. So it drove the lowest correlations between underlying stocks in history. And we have that. That's very well documented. People who come from single stock land think, oh, well, correlations were just really low for some intrinsic reason, and that caused really low vol. No, it was all because of vol selling. The index itself was pinned. And we know that within one standard deviation, that single stock vol was still within historic norms. It was really a function of the index itself not being able to move.
All right, I'm gonna risk sounding like an idiot here, but I'm gonna go through this like I'm 5. Vol selling. Are you selling puts?
You can sell puts or calls. Anything. A put is a call when hedged. And this is put call parity, which means a put and a call are the same thing if they're of the same strike, if hedged with one share of the underlying itself. I know it's confusing, but that's kind of options 101.
No, it's not. It's not that confusing, because if you own a share and you sell a put, then you're basically long a call. Is that what you're telling me?
So
or 100 shares and you sell a contract
correct.
or whatever.
So by
right?
that, that's why you're ultimately a call and a put have the same implied vol. They're priced on the same vol. And they are ultimately the way you price insurance is not a function of the strike or anything else. It's really, what implied volatility are we on? And that's the same whether it's call or put.
So if I'm selling a put, that means a dealer is buying a put. And in order to offset their delta position, they're buying stock. Yeah, because they're long the put. That makes sense. So you get into this scenario where the hedging of the dealer positions impacts the index. Is that kind of where you're going with this?
So in 2017, let's do the simplest example. Let's just say they were selling straddles. So they're selling a call and a put of the same strike at the money. Let's just say it's the simplest. And selling a call and a put of the same strike essentially is like an upside down V, right? If you buy a straddle, it's a up. You make money in either direction, but you pay a premium for each the call and the put. So if you're selling that, ultimately the buyer is long that vol, they're long the V, And in order to, maybe they paid a very low price for it because vol's lower than it's ever been. And maybe, they buy a straddle in the S&P 500, let's say, which is, let's say it's trading 4,000, and maybe they only have to pay, for the next week, they only pay $25 to own that straddle. Like, that's how cheap stuff got, right? It was crazy. But that means if the market goes down $10, then they probably are going to buy, because if it happens that quickly, they have a whole week to make $25. And it goes up 10, they're going to sell it again. Now imagine the whole world is long incredibly cheap insurance that's hedging. So market goes down, they buy, market goes up, they sell, and everybody's long. So the market just can't go anywhere. And ultimately, it's also a race to the bottom, because if the market's not moving, even if it's cheap, everybody's losing money. So then they sell it lower and lower and lower. And ultimately it gets to a point where somebody says, well, you know what? This is historically the lowest it's ever been by far. And guess what? I'll just own it. And at some point, it'll make money. And in order to do that, all those people own it, and they probably still lose money on it because they realize vol itself would still get even more and more pit. So this was the kind of the death spiral that we got into.
That's crazy. Yeah, because my mind would be like, who is selling vol that cheap, right? Because you're not getting much premium. But what you're saying,
because reflexively, the more that it got sold, the more it pinned the market. The more it got sold, the more it pinned the market. The more it was. And actually, ironically, people think because vol is quote unquote mean reverting, people who are not in the space think you want to buy vol when it's cheap and sell it when it's expensive. That's the broad thought out there. Oh, vol's high.
Yeah, that's what I would guess.
Actually, if you look at risk-adjusted returns, you actually want to sell vol when it's very low, and you want to sell it when it's very high. But in the middle, you want to be low. It's and honestly, it so rarely goes to the high end of the curve, like the really high level, that you actually it's actually generally inverse for the most part. Between 15 VIX and 17 VIX to a 30 VIX, you really want to be a long vol, and you really want to sell it below a 15 VIX. And then again, you want to sell it if it gets above 30. Again, it's not exactly that. Those aren't exact numbers, but it depends on the realized vol environment. It depends on what's happening. But that's the general rule historically. It's more of a you. You really want to sell it when it's low, because reflexively, when it's low, it's actually stable and it's pinning the market. And there's a reflexive effect of low vol on the underlying machine itself.
That's fascinating. You've got, like, I always think of the index as a derivative. So you've got derivatives of derivatives actually impacting the underlying stocks. And then you've got a bunch of these fundamental guys like me trying to figure out what's going on.
There's a whole
here.
machine at work. And actually, now I'm going to really blow your mind. Derivative is a term that was created for these things because they were originally made, the world of stocks and bonds started from companies. Like, I want to own the company, right? Or I want to give you debt. But if you think about it as a capital market thing, you don't have that mooring, that core perspective. All assets, and the way people think about them, is they either go up or down. It's two dimensions, right? The markets are much more complicated than that. Markets are a distribution of outcomes, right? All things are a distribution of outcomes. If I could give you two stocks from the same sector, would cover up their names and they have the same market cap, and you'd think they were the same. But underlying, you could have a totally different distribution of market outcomes. One could be very right slanted with a big fat left tail, and one could be very narrow set of outcomes, very low volatility, right? And but yet not a lot of positive upside, right? And yet you have the same market cap, because that market cap, that stock price, is ultimately just a summary of the distribution of its outcomes. What options are is options represent every single point on that distribution of the outcome of every asset. But like, oh, vol's an asset class. Vol's not an asset class. Vol is the asset class. Vol is the distribution of all outcomes for every asset. I can look under the surface at every option chain, and I can bet on every 5-point move or 1-point move in a stock or a bond or in an interest rate, whatever it is, based on the distribution of the option chain. And that's not just in time, that's also in moneyness, right? And it's really a three-dimensional picture of what the stock's potential outcomes are. So there's a reason people are like, what is going on with all this options volume? Like, why is this happening? Simple answer, they're superior products that give you much greater flexibility and much greater picture of what an asset is and what its risks and returns can be. At the end of the day, options are not really the derivative. Options are the set of outcomes, and the summary is the stock or bond or asset value. It is just the expected value of that distribution. So there's a reason that we're having more notional trading of options nowadays than we have single stock, because single stocks are two-dimensional, simplistic kind of views, summaries of the full picture. And we have, in a day when we have a factor and a style ETF, two-dimensional for everything on the planet, almost insane that it's taken this long for people to open their eyes to the fact that there's a much more data-rich, more flexible way to play the value of any asset other than just buy a stock or buy a bond.
That is super fascinating. It actually makes a ton of sense to me, because to your point, you're just basically summarizing a probability distribution in an expression of an asset value with stock at any given time. I do have an issue when retail gets involved, because I have a suspicion that retail has no idea about any of this stuff. I spent a decent amount of time studying some options, and I'm barely literate or competent in a conversation.
But that's true
right?
for stock too, right? So
yeah, that's fair. I guess with options, it's the speed at which they move. And like, I had a buddy who once told me, he was like, I think the stock's going to go up to here, so I'm going to buy a call. Say it was like a 25 and he wanted to buy a 23 call, and he had to pay like $4. And I was like, you're going to get destroyed by vol crush. And like, I don't know that people understand how the Greeks work as well as they should.
Absolutely. Probabilities themselves.
You obviously do.
Right. The probabilities themselves are kind of, people think that's too complex for most people, but people have an intuitive sense, right? We make decisions. If you ask somebody, a little kid who's 10 years old, who might be very smart, mathematically minded, but have never been taught what a stock is, it's confusing at first. What's a stock? What's a bond? What does it mean? But we learn. And the reality is with options and probability, again, it seems confusing because we all get caught up in the math, but intuitively, we all make decisions and weigh decisions based on probabilities every day. Our minds are probabilistic weighting machines. Like, what are the odds of this? How is that? What do I think is going to happen and why? What are the chances of that happening? That's how we make decisions. And I think anybody who's ever really taken some time with options, eventually, it's like a framework, it's like a language of how we actually think. And it actually is something that I think a lot of people are kind of learning and opening the mind to. I think of it like a technology, right? I think it's a superior, more flexible technology. It just takes time. It takes network effects, right? It takes more access to these things. It takes more education. It takes more products. It takes more liquidity, right? So liquidity in terms of people trading it and doing it to get involved. And I think we've really hit a tipping point with that stuff, and people are learning. But there's more. It also doesn't hurt that we're in a time of more nonlinear outcomes, right? Because of the kind of the removal of liquidity and the record valuations and record leverage in the system. But yes, I mean, to your point, there are always new participants learning, making mistakes, and there are several dimensions to how you price options, which can be a little bit more confusing. But I think intrinsically people understand that I'm better off if I think there's a chance of a big up outcome of something, right? To spend less money for a nonlinear, convex bet. And that is the nonlinearity. That's saying, hey, the distribution has a very fat right tail. There's a high probability of something happening that seems unlikely, but is very far away. And if it happens, I get a big payout. That concept is not wrong. That's right, actually. It just, the actual math that goes behind it might take some time for people to kind of put their head around and understand.
So how do you explain, when you said that, what went to my mind is tech stocks last year seemed to have been pricing in this right tail as if it was objectively going to happen, but obviously not so. I think some of that your answer probably has to do with liquidity. I'm not sure, but like how does the probability skew if we accept that world? Like if we accept the world where options chains create the equity value, how have equity values moved so fast
So we kind
far?
of touched on this a little bit earlier, but the difference between, so just looking at distribution and looking at the outcomes relative to an asset and keeping them separate would be one thing. That's kind of the first step. But there's more to it than that. There's a reflexivity, which we also touched on earlier. This is not tornado insurance. Buying tornado insurance does not affect the outcome of a tornado. However, buying calls does affect the effect. In a tech stock does affect the outcome on that tech stock because it actually, ultimately the dealer who's selling it has to hedge that risk, and that has an underlying effect on the outcome of that tech stock. So there's a circular reflexive effect in markets, and there always have been, and people have always under like big good investors like Soros, right? They've always understood that there's this reflexive effect to markets, and there's a reflexive effect in life broadly, right? If right now we have inflation, so guess what? There's going to be effects. People are going to react to the fact that we have inflation to probably try and lower it. So there's, that decreases volatility, et cetera. There's mean reversion and reflexive stuff, but it is embodied in markets in the option space. If you go and buy calls, like I said, it'll affect the underlying. If you buy puts, it'll go and affect the underlying. So those probabilities themselves ultimately are affected by the supply and demand. And that's where the dealer flow comes in. And this is something that we've been doing for quite some time. Understanding the market structure, understanding the reflexive effects of that positioning on the underlying is critical to being an investor in this day and age.
And so if people are buying these out of the money, long dated calls, say, correct me if I'm wrong on any of this, but you're going to have less delta and more gamma. So gamma is the percentage of the option that increases for the next dollar move. And this is where we get these gamma squeezes, right?
Yeah. So the gamma squeeze piece, this is kind of the first thing that people started thinking about, right, in terms of options recently, is if you get enough volume on the tail, right, and you get entities to be have to sell enough of it, right? If there's an imbalance to a point, something that has maybe a 2% chance or a 2 delta of being in the money, as you start to approach it, the people, we'll just walk through an example. If a bunch of people bought a 1 delta call out of the money, the dealer sells all of these, they have to buy some stock against it to hedge it, right? So that's one. Okay, you have a hedge of 1 delta, but now you go up quickly. You start squeezing.
For those playing at home, it's a small amount of money. 1 delta is like 1% of the contract.
Correct. Sorry, 1 delta means per point move in the stock, the price of that option moves 1 cent. Okay, so it's like 1%.
Yeah.
Now, gamma, just to be clear, is the change in that delta and that percent probability, that percent change in the price. And so as you go closer to something, especially if something becomes at the money or at the price of the stock, it has a 50 delta. It has a 50% chance of being in the money and has a 50% chance of being out of the money. And that 50 delta means that if the market goes up by 1, the price of that option goes up by 50 cents, right? And eventually becomes in the money. It becomes 100 delta and essentially becomes stock. It's so far in the money, no different than stock, and it moves by the same as stock. So this is so gamma is the change in that delta. So when you start with 1 delta, eventually you move quick enough, it'll become a 2 delta, and everybody will have to short those calls in long stock will now have to buy when the market goes up. It's the opposite example of the thing of pinning we talked about in 2017, right? Market went up, they got to sell vol because they were long vol. The market went down, they got to buy vol. So buy the market versus and sell the market when the market up. Now you're short. The dealers are short gamma, which means that the market goes up, they got to buy more stock. If the market keeps going up, it goes from a 2 delta to a 3 to a 5 to a 20 to a 40 to a 50 to 100. So this is kind of what people refer to as the embedded leverage of options. As you get closer to whatever that call was being in the money, it is intrinsically creating a greater and greater percent short in the market. And there's so much leverage behind that if they do it at big enough size, there aren't dealers that are big enough that eventually those dealers have to buy back the calls. Like in the case of Melvin Capital, who basically got blown out by being short all of these meme names that had no real intrinsic value, but they went to infinity. They got caught up in a gamma squeeze and they had to buy back the calls that they were short. And ultimately, that even only exacerbated it more and made it go up even more. So there's a reflexive, again, effect here. By buying gamma, especially on the tail that has high convexity, you can force short gamma by dealers, which means as the market goes up, it goes up more. So there's an opposite cost of that. I mean, I don't want to go into all the details and all the Greeks, but as options decay, there's a separate effect that's not just based on price. That's called Vana, which is or charm, which is the opposite effect. So if I traded a 30 delta call and I bought them and dealers were short that call, but the market didn't go anywhere or vol decreased, that 30 delta might go to a 1 delta just based on time and the reduction in vol. And as the vol reduces or the time passes, over time, dealers who were short that 30 delta call and long stock now have stock to sell. And so those are opposite effects, and they're a function out of the market move, but in the move in time and move in implied volatility expectations for the market. So it becomes a little bit like 5-dimensional chess in some ways, but understanding kind of the effects of time, the effects of implied vol, and the effects of market move, and knowing those positions, you can now map out what the dealers have to do and what the effects of that will be as time and market moves, et cetera, change.
This is blowing my mind.
It's a fun game.
My takeaway is unless you're flying low to the ground, you're very subject to all this stuff. And then even if you're flying low to the ground, you better hope you have a management team that understands to buy stock.
But I mean, to be clear, understanding this stuff is critical. And I think there's been a lot of education around it lately. But I think, listen, if you're trading in markets in the short term, again, to be clear, a year or two is still short term. Not just daily, weekly, monthly, but if you're looking multi-year and you're subject to valuations within that short period, fundamentals aren't going to really help you. It's really, you need to understand where supply is and where demand is and why it is the way it is. And part of that is options markets. Part of that is the Federal Reserve and liquidity. So there's all these things are critical to be a participant in the markets.
Man, I could listen to you go on like this forever. I don't want to run the conversation too far forward, but I know one of your passions is macro, and it feels like macro is driving a lot right now. What's going on out there? Because it seems like there's nowhere to hide except for the US dollar.
This is going to take a little bit longer, but let's start from the beginning. And I think it's very important to start from the very beginning. If you think about, when we talk about macro, it's less about geopolitics. I think the most important thing, that geopolitics affects it, but the most important thing is to start with the machine and the liquidity and how it's driven, how the economy is driven. Here in the US, our founding fathers created a system to make it very difficult to pass policy and to pass laws. That was on purpose. They didn't want a situation where the elite, the wealthy and the powerful could affect laws. They put a lot of checks and balances in place. So absolute power didn't corrupt absolutely, right? That was on purpose. The problem with that is it created a situation where we would only pass laws and make changes if we had a crisis. And we ended up having a lot of crises over several hundred years, a lot of booms, a lot of busts. And I'm starting here at the beginning. I think it's important to understand. So those booms and busts, eventually people got sick of, and people said, look, we can't seem to.
Yeah, this is not fun.
And we understand that you need checks and balances, but there's got to be somebody who's watching the economy who can react more quickly and not in a time of crisis. So they created something called the Federal Reserve. And the Federal Reserve they didn't want to give all the power in the world because that would be extra governmental and total, and that would ultimately be dangerous as well because of ultimately absolute power in theory could corrupt that and take the reins of the economy. But they did give it quite a bit of latitude. They said, look, we're going to give you one tool, monetary policy, not fiscal policy. We're going to keep the power of the purse in Congress, but we are going to give you two objectives. So we're going to give you a very simple function that you can manage the economy with. So we're just going to tie one hand behind the back and give you monetary policy. And we're going to say, hey, the only things that you have to worry about are price stability and maximum employment. It's a very simple function to run the economy. I think the economy might be a little more complicated than that. I don't know.
Yeah, it seems so.
So what happened? Well, eventually, when we got taken off the gold standard by Nixon, and there was no longer a mooring, we moved to a fiat-based system. And there was only one entity really running the economy. The monetary policy became dominant. The Fed became the only game in town. Anytime there was a slight issue or hiccup, the Fed would come in and it would stimulate and it would create a monetary response. Now, monetary policy is not the same as fiscal. Most people don't understand this, but it's very important. Monetary policy, what it does is it controls interest rates, or in recent history, it buys assets to reduce interest rates as well and provides liquidity. Stimulus that's coming from monetary policy goes to capital. It goes to corporations. It goes to entities that can borrow money. The only entities that can borrow money are wealthy individuals and or corporations. 50% of the United States, median person, very little debt, if not no debt. Okay. If you are sending money to capital, if you're sending money to the top, what that does is and we talked about this at the top of the show, it reduces the cost of money. It allows corporations to bet on 20, 40-year outcomes. It creates infinite liquidity. And that's essentially trickle-down economics. It's supply-side economics. You're sending money to supply. I've given this analogy. We call it sending money to planet Palo Alto. You send money to all the corporations. It's another planet. Imagine San Francisco and Silicon Valley is another planet. Might as well be. And you send that money to planet Palo Alto, and that money never hits our shores. The velocity of that money is zero. Okay? But that money that goes to those corporations creates crazy new technologies and new ways of doing things. It creates Teslas and Ubers and Amazons and all kinds of incredible things. And all of a sudden, from planet Palo Alto, this advanced society, they send back these technologies to our shores. And those things are not money. That money never hit our shores, right? And those things are supply. Those things reduce the cost of things. They make things faster.
Yeah, they're consumer surplus, basically, or
so
have been.
Lowering interest rates sends money to wealthy people who only invest. They don't really buy goods, or they buy luxury goods and you get inflation, that stuff, but that's not really real. You send money, they buy more investments, which sends more money to capital, which creates more technologies. So what we've done is we've created, since 1980, since going out the gold standard and making the Fed dominant, we've created a technological revolution. Again, I don't know how old you are, Bill, but I'm 45 and I grew up, I was born in the 70s, and I know well enough to read. When I started reading books, it was all about the future and stuff that never happened. I watched The Jetsons, and it never happened. I read 1984, and it never happened. I watched 2000 Space Odyssey, and it never happened. The future could never come fast enough. But guess what? Monetary policy and unlimited capital, we created 40-year time horizons for investments for 40 years, and we've created Amazon, and we've created Tesla, and we've created Uber, and a million other companies that never would have existed because they never created cash flows, but created advancement and better supply. That is deflationary. On top of the technologies and advancements we've created massive globalization, because when you send money to corporations and in limited amounts of it, they want globalization. They want to export and they want to reduce their costs. It is natural selection. It is free market economics on steroids. It is the reason we as human beings have advanced over 100 million years, right, to what we are today. Competition, free market economics, nature is powerful. It's raw in tooth and claw. It is a great system for optimization. The problem is Yeah.
Real quick, I just want to like double click on something. Why do corporations want globalization?
Reduce costs. Competition.
Yeah. Okay. Just wanted
the
to
profit
okay.
maximizing entities at the end of the day. They
Makes
want
sense.
to create a better good for cheaper. And it's incredibly competitive. Just, again, it's competition. It's survival of the fittest. You put a system in competition, survival of the fittest mode, and you get crazy outcomes because people, especially if you add unlimited money into it, right? And so at the end of the day, we have gotten a system broadly that has created historic margins, right? Where price to sales has been at record levels for a while, but people are still talking about price to earnings being not that far off because we've created infinitely better, like an order of magnitude higher margins because we've reduced costs dramatically in the system by creating new technologies and again, globalization as well, reducing labor costs. Now, that's all great. It's free market economics. We've seen significant technological advancement. Sounds great, but it's doing its job, right? Doing what it's been told. It's maximizing employment, right? And at the same time, price stability. It's actually been deflationary to do this. So they've been able to do ad nauseum more of it. Problem is, they only had two objectives, price stability and maximum employment. If you do this for 40 years, which is what happened, there are people and human beings in this system. And all the money went to the top for 40 years. We had 1.75% GDP growth for 40 years. In real terms, about 0.75 of that growth in real terms went to the median person. The other 1% went to the very, 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 very top. And 1% over the whole economy to the top 1% would mean 100% growth a year for 40 years. That's what we've experienced. We've totally hauled out the middle class. And again, this is not a judgment political statement. It just is what happened. And so about, 7, 8 years ago, you started hearing a lot about inequality. A lot of books were written about it. And you started getting something called populism. Populism did not just happen here in the US, it happened globally because everybody was subject to the Federal Reserve and central banks' activism over those years. And importantly, that populism was not just in the left, it was the left and the right. Donald Trump was populist, believe it or not. I think we know that now. He's not right, he's left economically. Bernie Sanders was left, now he's even more left, right? The whole system shifted left.
Yeah.
And our founding fathers, going back to the very beginning, created a system to respond to crises. And it takes crises to make change. And that built up big to a point where inequality got to something that the left and the right, everybody was concerned about. And then COVID hit. And all of that right, Trump brought the right left, and the left was in charge. And now we passed $12 trillion of fiscal stimulus. It is an order of magnitude more fiscal stimulus in real terms than we've ever gotten. The New Deal in the 1930s, which filled a decade-long hole called the Great Depression, was in real terms about $1 trillion. Now, that was the size of, the economy's 1/10 the size. So if you normalize for the size of the economy, let's just say more or less, this is the size of the New Deal. The difference is that plugged a hole called the Great Depression for a decade. We're not in the Depression. Look around you. So what fiscal stimulus does, unlike monetary, is it doesn't send money to capital. It sends money to human beings. People got a lot of money, particularly on the bottom, and they're all of a sudden, for the first time in 40 years, looking around saying, wow, I have money in my pocket. Now look at this. And they started spending. And that was the goal originally of it, right? But it was also to help with inequality because populism was the name of the game in fixing that. But it really did way too much, way too quickly. And it was a response to just built up problems in the economy for 40 years. And so that demand push, which is again velocity of one, this money is not going to Planet Palo Alto. This is helicopter. This is going directly into pockets. Creates that inflationary push. Now that happened at the same time as supply problems globally because of COVID, and created a massive
it got constricted. Sure,
supply and demand imbalance. So we called for this well before it happened, actually back in 2020. And not a surprise, this is where we are now. Now, the problem is that's not all that's happened now, right? Now we had a supply-demand imbalance and a shift to fiscal and inflation. The response now, for the first time in 40 years, the Federal Reserve, which has two mandates, price stability, and maximum employment, now just can't just keep doing monetary policy to stimulate and get a deflation response. They have inflation to deal with. So now all of a sudden, 40 years of monetary policy has to be pulled back in order to deal with inflation. Now, the problem is the Federal Reserve, as we talked about, if you stimulate monetarily, you send money to Planet Palo Alto, that is deflationary. Taking money away from Planet Palo Alto is not deflationary, right? It's actually taking money away from supply. We are not in the same economy we were in the 1970s. The system does not work the same way. Labor for most of these corporations is mostly abroad. It's not here domestically. Right? You pull away from these corporations, you're going to get less supply. But you're not necessarily going to hurt demand that much. The way you hurt demand, ultimately, is through the wealth effect. And so the Federal Reserve essentially has one tool now with which to combat inflation. And it's this wealth effect in capital markets. And the reality is most people in the bottom 50th percentile don't own stocks anyway, for the most part. They've just entered some.
Interesting.
And they're not really ultimately.
You're attacking something that doesn't really actually accomplish the goal until you create a huge recession or something.
That's exactly right. So the only way they can affect ultimately inflation in this environment is essentially to pull back away from supply and demand and crash markets. And it's like dropping a nuclear bomb on a forest to clear the underbrush. It is not. Yes, it will clear the underbrush, but is that really what we want? And so there's some real confusion at the Fed and at policy in general of how these tools work and how they're supposed to work and their mandate and how they can even control inflation in this environment, because they really can't. And so, we started at the beginning and now we're here, but we are essentially trying to unwind 40 years of inequality and combat populism, which is not going to go away overnight. And it's all been exacerbated at the same time by now macro geopolitical issues. So right when we're getting inflation, and this is not a coincidence if you ask me, we don't know this, but Russia understands that inflation is underway, understands some of these issues that are at work. And they understand that their strength ultimately is through their dominance in commodities across the board, and particularly as it relates to Europe's dependence on them during a time of inflation. And so Putin saw it as his opportunity, that he had leverage in this situation to go into Europe and make strides in Europe. Now, obviously, things have not gone exactly as planned. But now that we are here, we are seeing even greater inflationary push from the commodity side, because Ukraine and Russia ultimately are not only Russia is one of the biggest energy exporters in the world, but also wheat and fertilizer, which are foodstuffs that are incredibly important to long-term sustainability, particularly outside of the U.S. and less developed markets. Or also, something like 40% of worldwide grain comes from those two places. So the commodity push has gotten worse, which has put the Fed in a bigger box, which has caused even bigger problems. Now, that wasn't enough. China has supported Russia, and they also see this as an opportunity to counter the West for long-term strength, stability. They also realize in an inflation regime, they're at risk if they don't have a partner, that they have stable exports. So they see themselves at risk, and they see this as an opportunity at the same time. So they pair with Russia. And now we have the risk of the unwind of globalization, which was one of the three legs of the stool that created this whole thing in the first place. So don't mean to scare you, but this is a dangerous time.
No, and on top of all this, whether coincidental or not, I have no idea. My tinfoil hat thinks maybe it's not, but the zero COVID policy and shutting down the ports only exacerbates the supply chain issues that are currently going on. And I guess maybe now that Target's saying they have a little bit of over inventory because food is eating up people's wallets, maybe some of that pressure stops or whatever. But yeah, this seems like you want to be flying close to the ground or not flying at all. I'm not sure.
That's right. Now let's step away. Also, things that are connected to this whole picture, right? One, monetary policy has created technological revolution for 40 years, right? It's also created a great distrust about government because it created this inequality. Those are two things we just talked about, right? What generations were hurt the most by this inequality? The generations that didn't have assets, that were coming into the labor force during this. So there's been no capital appreciation until really no building of nest eggs by millennials on down. Whereas baby boomers who had all the assets have dramatically benefited from all this. So it's created a schism between boomers and younger generation. It's created distrust by the younger generation of government broadly. And right at a time when for 40 years, these generations have thought technology can solve all of our problems. What does that sound like? A little crypto, right? And so this is the reason crypto has been the religion of this generation and why it has seen such meteoric growth. There's also a group of people who has underperformed and needs to catch up desperately. They're in the 30s now. And so what do you bet on? YOLO calls and crypto convex outcomes. You do it through Wall Street bets. It's sometimes religious and almost existential. And that's what created crypto. It is now tied to that generation. So I'm not here to say it's not going to be a thing, because that generation has adopted it as such a critical part of who they are and what they want in the future as an expression of who they are. So I think that's important to kind of realize. What is crypto? Where did it come from? Why is it here? It came from monetary policy dominance for 40 years. So anyway, we can go on. There's kind of other pieces to this picture, but there is monetary policy, and those effects have affected every facet of our lives over this period. Whether it's globalization, whether it's technological booms, it's crypto, it's kind of growth, and as that begins to unwind, and you start to get rebalancing, we are at such a tail end of the pendulum swinging that things get a little messy on the way back. And so I think it's not going to get solved.
I missed inflation mostly because I'm like the goldfish that's swimming around that doesn't know he's in water, right? And it's like I'd seen so much monetary policy not result in inflation that I almost like thought, and I'd still have to get it out of my head that, inflation's dead, right?
Yeah.
And even if we send this money somewhere on the back end of this, we're going to be back to the same regime in 2 years or whatever. I'm beginning to realize how hard an inflationary spiral is to stop.
Yeah, I mean, this very straightforward concept of monetary policy versus fiscal, the concept of just money printing is the same no matter who you send it to is a major cause of confusion by most people. People just think, oh, there's more money, so it's worth less. If that money does not enter the economy, it doesn't matter how much is printed. Yeah, I can print $1 gazillion and put it in a box and hide it under my bed, and it won't change, right? The value of the dollar. The question is, they call it velocity of money. I think that's confusing, but how much money is entering the economy? But really, what it is who's it going to? If it's going to people who spend it and buy stuff with it, then yes, it's increased money supply. But if it's going to entities that are just creating more goods, that's not inflationary. That's actually the opposite. It's deflationary. And I think that broad understanding is completely lost on most of the public. Honestly, it's lost on policymakers as well. It's part of why we're here.
Yeah, I mean, I as you're talking, I'm really fearful of the people that have started to invest in the market at the time when monetary policy is potentially going to get quite tight, and they probably already have some distrust in the system. I don't know. This could end up, there's some risk out there that I feel like I have underappreciated in the past, at least.
Yeah, I mean, absolutely. Look, it's actually in the long run good that we are not going to an even greater extreme, right? The more people can listen, again, our founding fathers created a system that was supposed to respond to crises. If it's flexible enough, create, a kind of rejuvenation of some of the ideals and the things that make us who we are, and will fix things. I think part of the problem is the Federal Reserve muted that response for 40 years. And that's part of why there's greater instability. And there are cracks that have been created in the system because of it as well. Whether you look at Citizens United or gerrymandering in the political system, all of these things happen because of the corrosive power of money in politics, and the power that's been concentrated at the top because of inequality that's been driven by the Fed. And at the meantime, we haven't passed any laws or been able to pass laws because the Fed has come to the rescue every day. So it's good to have some crises now and then. You just don't want to keep letting the system build up with bigger and bigger problems. Again, it's good that these things are happening now and not in 20 or another 40 years, because heaven forbid what that would look like. It has been a long time. It's going to be scary. Hopefully it's not existential. I'm optimistic that it won't be. We're lucky, to back away here in the US to be on an island with the biggest economy in the world, biggest military in the world, self-sufficient in terms of commodities and food and energy. Is why the dollar is going through the roof right now. We are a safe haven in an otherwise very turbulent world. It doesn't mean we're without risk. There's no risk of internal strife. Again, if we have a problem, ultimately it'll be internally, but at least we have a flexible enough system. It's not an autocracy to, in theory, rebalance and not cause a revolution, but more of an evolution. And so I'm actually long-term more bullish and optimistic about the U.S. and its outcome because we're having this crisis, as opposed to if we had continued down the same path.
The other political shame of where we are is I've seen Bezos speaking out about inflation and whatnot, and the perception that I think people can have, and perhaps rightly so, is it's like, oh, well, now it's a problem. Now that people that needed the money have the money, now it's a problem that we're getting money, right? It was never a problem when the wealthy were getting wealthier, but now that people actually got some help, now we have to really worry about inflation. And I think whether or not I'm confused on how much is reality and how much isn't, but I know perception is important in politics, and I've seen that come back from a number of my friends have commented on some of the threads that I've seen lately on Twitter.
Absolutely. I mean, listen, most people don't understand how the machine works, and they're never going to. And you can try and educate. That'll help a bit, but it's confusing, and there's a lot of different levers. But the reality is, this dynamic between populism and optimal outcomes, fairness, if you will, for lack of a better term, and maximum growth for our best outcomes, is a tension that's existed since the beginning of man, and actually any community, even before men, even in nature. Survival of the fittest, ultimate outcomes are best in a competitive world of survival of the fittest. But your mom told you when you were a kid, life isn't fair. Nature is raw and tooth and claw, but that's what creates progress. So at the same time, in a community, in a society, people look at that system and say, hey, that's not fair, right? I can't let to give an illusion, to give an example, Socrates used to have he had a statement that a polemical question was, do you give the best violin players the best violins, or do you give the worst violin players the best violins? And his answer was, you give the best violin players the best violin because you get infinitely beautiful music. You get the best outcomes. But what happens to all those other violin players, right? That's not fair. And so this tension between nature and free market economics and whatever you want to call it, which is the ultimate best system for growth, and this leaving other people behind, is the tension between left and right. It is communism versus full unadulterated libertarianism, right? It is right versus left. And it's a tale as old as time. And this pendulum swings because ultimately, at some point, absolute power corrupts absolutely. And they say, let them eat cake, and then they burn it down. And so, here we are, right? It was let them eat cake, and now there's a burn it down mentality. Luckily, democracy is generally suited for not burning it down, but just kind of putting small fires around and trying to then putting them out until we kind of fix the system enough that people are able to handle it. That's why the founding fathers created this system. So again, this is not a new thing. What we're going through is not a new thing. The details are different. It rhymes, but they're all related. And we'll be back here again. If you go 100 years in the future, we'll go through another set of these. At the back end of the next 10 years, rebalancing and populism and rebuilding a middle class or whatever it is. Interest rates will be higher, and we'll have room to do supply side economics again and promote nature and free market economics on steroids, and we'll have awesome growth. The next cycle will begin, and then eventually it'll go too far because those people will want the money that they've gotten, feel like they're entitled to it. The people on the bottom will want theirs, and it will start over.
So I think you maybe just answered the question of how does this end, but it sounds like in a potentially cathartic but scary sort of I don't know what the evolution, I guess, is probably the best way to say.
You hope it's not complete burn it down, right? We hope it's not a revolution, and that it's a kind of revolutionary impulse that at least leads to a revitalization and rejuvenation of the structures and things that we have. Again, I believe that's the case. Our system will not last forever, but it is thankfully a system that was created to be fairly robust and flexible and allow for us to rebalance. Again, hopefully we'll get rid of some of the problems, the cracks that we're creating, the entropy that's happened in the system. Again, I'm not going to preach about this stuff, but Citizens United, like I said, gerrymandering, money in politics, all of these things, voter rights. This is not a Democratic or Republican thing. These are our system, making sure it operates for everybody and doesn't get corrupted ultimately and fall apart. But if we can keep this system in place, it is meant to rebalance and allow for the revitalization and a new path forward.
My buddy Bill, he's into the monetary plumbing. He loves this stuff, and he's always sending me the tax receipts like up to the day. And he has pointed out how much money is going from society to the treasury right now. And he's like, this is massive fiscal tightening that no one's paying attention to. And I think it's interesting that you're talking about the monetary tightening going on at the same time, if he's correct, of the fiscal tightening. Certainly on a rate of change basis, we're getting tighter. And then if you think of inflation as sort of a tightening force as well, I could see how that could create some downside risk. But I guess some people would tell me, well, you're late on that thought. You should have thought that in 2021. I'm not sure it's over.
Yeah, I mean, look, if at the end of the day, we're pulling money out of corporations' hands and reducing supply, that's going to exacerbate inflation because there's less supply. If you're adding money at the same time, to people's hands via fiscal, right? You're creating demand. Now, inflation ultimately is kind of a resolution of that, and that it ultimately is a flat tax and takes money back from these people, right? I think in the U.S., we are going to have secularly increasing inflation. However, like I mentioned, we are fortunate to be, in a position of strength. And as the raises rates, we are getting massive dollar strength, and I expect that to not only continue but accelerate, which will allow us to export a lot of that inflation. And so, the dollar strength will ultimately make us the best place for inflation in our neighborhood, and it will make it a lot worse overseas.
This is going to crush importing emerging markets, won't it?
It gets worse because as the dollar gets stronger, a dollar-denominated debt becomes eventually a crisis all over the place.
Yeah, that sucks.
Not to mention now talk about all the wheat problem, the food issues and food insecurity. We are, as a country, we have our own food and our own commodities. A lot of other countries don't. And that's the problem now. But the fertilizer problem, not enough people are talking about it. Next planting season, we are going to have a major food crisis. And we will be fine here in the US. But overseas, we're going to have mass famine. Right? And that sounds scary, but billions of people.
No, I think it's true, man. That I've been thinking for a while because I used to bank food production companies. And I know how important natural gas is to nitrogen, right? And you can skip a year of potash. Exactly. I'm pretty sure it's potash that you can skip, but you can't skip two. And you need phosphate all the time. And it's like, this stuff really matters.
So now imagine you don't have a democracy that's flexible. You have an autocracy. And imagine you don't have food security in your country. And now imagine that you have dollar-denominated debt. There are going to be a lot of new countries on the map in about 5 years. And there's going to be a lot of not evolution, but revolution abroad. And that stuff will be a problem here in the US. That's how we're going to have problems in market instability over this period. Expect a lot more. 1998, long-term capital management blew out here, not because of problems in the US, but because of Asian financial crisis, because of Russian ruble crisis, because of dollar strength, because of a tightening cycle in the US that exported inflation. So this won't be the first time. It won't be the last. Again, these are old stories. This one's particularly bad because it's the first real inflation we've seen in 40 years, and it's likely to be some of the worst.
Well, this is depressing, sir. I'm going to need a drink.
But it's the cycle. It's like the cycle of life, right? Like this is good in a sense, in the broader sense that we are in need of rebalancing. It gets worse if you don't. It's all about the Tao of life, like the balance, like everything eventually has to come back because you can only go so far, and we've gone too far.
Yeah. I mean, I am on Value After Hours. My co-host Jake has been talking about concepts like this forever, and I've been the guy that's been a little too dismissive of them. But thankfully, I'm smart enough to wake up occasionally, even if it is a year later.
Well, it usually takes longer than you.
What a wild time!
It usually takes longer than you think for these things to happen. So it's probably better to be in your shoes. I mean, I've been sitting here talking about these things for 3 years, and who knows how much returns I've missed in the markets or whatever. So being late a little bit is not the end of the world. Honestly, being early sometimes in financial markets is worse.
I think the interesting thing about all this is I used to complain a little bit about, like, a younger me really complained about what Netflix was doing. And I was like, look at how much cash they're burning and the debt market is taking equity risk and this is nonsense. But there's going to be a group of companies, if this theory proves out correctly, that is used the last 20 years to establish a competitive position that's pretty darn strong.
That's exactly right.
Because it's going to be hard to attack.
100%. And not just that, some of those places will be the only place to hide, honestly, because they won't have inflationary push. Technology will actually have a massive headwind from inflation. People want to reduce costs. In a world where globalization is unwinding and inflation is a problem, how do you solve it in the US? We don't have enough people. Maybe we want to get paid too much. So there's a massive push by corporations to try and reduce costs through technology and innovation, et cetera. So there's corporations that will weather the storm, that have enough cash flows. They might be in the best position of all. And so yeah, it's you're right. Again, Amazon may never have existed. That's hard. Not many people are going to listen to that and believe that. But if we hadn't been in unlimited monetary stimulus mode, where they could essentially not have to worry about having cash flows for 20 plus years. But now that they are Amazon, you better believe Amazon is going to be the Walmart forever until the next cycle and somebody else kind of has a better solution.
Yeah, that's wild, man. I guess I get it. I don't know. You shook me. I'm just sitting here thinking about whether or not I need to pour a drink if we're going to talk anymore, or whether or not I should wait.
Oh,
what else fascinates you?
I eat, sleep, and breathe this stuff, man. I tell people, the macro thing, if you think about it, it's not where I've been in the business really for all this time. It's been in the plumbing. But I was, born in London, lived in Turkey as a kid, and I moved to Texas when I was 5. So I was that kid CEM, trying to wear cowboy boots and fit in Texas and always like a square peg in a round hole. So I asked a lot, with parents, I look at my parents and be like, who are these people? Like, this is, who am I? What is this place? So I think I just asked a lot of existential questions at a very young age and asked a lot of I didn't grow up with a certain religion. I grew up on the border of religion. So I was always very unmoored. And when you're unmoored as a kid and you ask just a heck of a lot of questions that people don't ask till they're 18 or 16 or whatever it is. And so it's just become, I thought a lot about this in my 40s, but it really is really that little kid that was just kind of trying to figure it all out and very lost and confused at a young age. And I think that's just driven a passion for kind of understanding how the whole machine works. And it takes a while to figure it out. But once you find out more and more, it's really fascinating. It's a wonderful hobby or love to have, and I'm fortunate to be to have it.
Yeah. It's amazing, man. Were your parents like educators? What made your parents move around so much?
My dad's a PhD structural engineer. He designed offshore oil platforms for oil companies.
Oh, wow.
So hence the connection between London, Turkey, Texas, and then eventually Norway. They moved to Norway, and I went to boarding school on the East Coast outside of Boston, a school called Andover, which also opened my eyes in a lot of ways.
Yeah.
Because I got to really kind of interesting people from all over the world. And really, I tell people I went from Saturday Night Lights, like football and chicks to Dead Poets Society, right? I was like
man, from Texas to Andover, that would be a change.
And it fit me a little bit better, I think, being at Andover, because it was more like people from all over the world that kind of thought a little bit differently, I think. So not for everybody, it was definitely a good fit for me. But anyway, so my dad,
that's awesome.
We always talk policy and politics over Turkey's an interesting place too, because it's at a crossroads itself. It's always been on the border of Europe and Asia and never quite been just one kind of thing. It's kind of a couple of different things. It's secular, but it's Islamic. It's a free market economy, but at the same time, it's always been the center of trade. It's always been the crossroads from Europe to Asia because of the Ural Mountains, the Black Sea, and then Africa was Asia Minor was the only place people could go from east to west. So I really grew up with this culture that really appreciates kind of the connections between different cultures and different things. And so we would sit around the dinner table and talk politics, at a very young age. And so I could definitely cut the bug that way as well.
That's cool. Well, I'm going to, I try to do it as it is, but I'm going to really try to lean into my kids' questions. My oldest asks 1,000 questions and they're all adult. And rather than letting myself get frustrated, I'm going to hope that I can foster curiosity that leads him to become
this
you
is a shout
when
out
he's
to
older.
My mom, I will say, as a kid, early on really encouraged me to ask lots of questions. She was and she was so good about just answering everything. And I got the bug where I just ask questions. This is pre-internet, right? This is I couldn't go look stuff up.
Yeah.
At least you can go point your kid to Google, right? Like back then, my mom would just answer them again. And she's an engineer, but she was a stay-at-home mom, but she was an engineer by trade, so very bright woman as well. And so I was just very fortunate to have somebody really foster that curiosity and push along. So yeah, if you're ever wow, is it making a difference? It makes a difference for sure.
That's awesome. And Chicago is now home. Are you going to stay in Chicago?
So I've been here it's crazy, 24 years. I never lived anywhere longer than 4 years anywhere before moving here. I came out here straight out of college and had an incredible opportunity. And I started, having success in business here. And I met my now wife. I have 2 wonderful kids, a 10-year-old and an 8-year-old. And the great thing about Chicago, again, once you have a family, I can't think of a better place. It really is, especially if you're a city person. Living in New York or London is very hard. Living in San Francisco, and not just expensive, it's just hard. You have less space and everything's difficult. And I get kind of the best of all worlds here. I have a house right by Lake Michigan, right by the beach. My kids' school is walking distance. We're in the center of a cosmopolitan city with incredible all the trappings that come with it. So just like anything, balance. There's good and bad to everywhere in the planet. A lot of people like Chicago. Why Chicago? The winter stink.
Chicago's the best, man.
Town, man. And
I lived there for 17 years, came down here in the pandemic. I'm in Florida now. And I realized after we moved, one, my wife got like super cold in Chicago.
Right.
She grew up there, but like she realized how cold she actually gets a lot. And then part two is I realized my grandma needs a lot more help than I had appreciated when I was remote. So, we're here until she passes at a minimum, and then we'll see what happens.
Yeah, I mean, I think there's like a Boaz Weinstein song or something like where he's like, you got to go live on the East Coast, at some point before it makes you leave, before it makes you too hard. You got to live on the West Coast at some point, leave before it makes you too soft, right? I think like everywhere is wonderful in some way or another. And I was very fortunate at a young age to live abroad, Turkey, Norway, Texas, East Coast, all that stuff. So kind of got a lot of that out of my system, found a place that was good for me and my family. And, again, I think, maybe 8, 9, 10 years from now, maybe there'll be a point where my kids go to school and we go elsewhere for a little bit again. But it's been wonderful being here.
Yeah, well, I miss Wes Randolph like crazy. I tried to speculate on real estate, and I bought across from Cabrini Green when it was still standing. There were 4 towers standing, and I should have just bought the West Loop. Yeah. That one
Our
hurts.
offices are in River North, not that far from where, on the south side of Chicago, not, where it's really come into its own. And it's, River.
Yeah, it's nice.
River North is actually really nice nowadays. But yeah, it's still evolving. It always takes longer than you think, right? That Cabrini stuff happened like 20 years ago, right? And it's still, there's still stuff there, right? And it still hasn't completely been developed.
You know what screwed it? Well, a number of things, but I didn't realize that my side of the street had a different alderman than the side of the street across from me. And after living in Chicago for long enough, I realized how much that matters.
I mean, it's all politics, right? This is, Chicago has changed in a lot of ways, but that's still very much a part of what it is.
Indeed. Well, I'm going to let you go. I have enjoyed this immensely. I hope you'll come on again sometime after I can calm down and get my emotions. I don't know. Calm down is the only way I know how to say it, but I really appreciate it, man. Thank you.
Thanks for having me. I'd love to be back someday. Take care.
All right, cool.
But it's absolute